There are lots of different ways of identifying trends, but which are the best techniques we can use when trading? Hello, I'm David Jones from Capital.com, and I thought this time around we'll do a video that's a little bit different, but I hope is going to be really useful. I qualified as a technical analyst back in the mid-1990s, so I've been a technical analyst in financial markets for more than 20 years. And in this video, we're going to take a look at various different ways of identifying trends, trying to follow a trend in a market, trying to spot when a trend is running out of steam, and then getting on early into a new trend. I'm going to look at 4 different techniques for doing this. There's been a couple of questions on previous videos about the platform I use. It's Capital.com's platform. So if you go to the website, you can sign up at Capital.com for a demo or for a real account and start trading with as little or as much as you want to. And one final thing before we get into it, of course, if you're watching this and you haven't subscribed, if you can subscribe, support the channel, and we'll continue to push out hopefully interesting content like this. But first of all, let me give you a taste of what we're going to talk about. Let's just jump on the platform and talk through these techniques. Then I'll come back and go into it in a bit more depth. So just to give you a quick taster of what we're going to go through in this video, identifying and following trends, we're going to start off looking at simple trend lines. Then we're going to look at moving averages to identify a new trend starting in both directions. Then we're going to look at RSIs, the way to use this divergence to try and spot a change in trend to help you get in on a new trend very early. And then finally, we are going to look at Fibonacci to try and identify whether a pullback in a trend is just that or something a bit more serious. We'll come back to all of this in a second. First of all, let me talk about the first topic. So that's given you a flavor. Let's deal with topic number 1. We're looking at trends. So the obvious technique to use, the simplest technique, I think, is trend lines. Let's get into it and look at some examples. So the topic of this video is identifying trends. I would say the easiest way to identify a trend is just look at the market in question. Here's a great example. This is the chart of palladium. And I'd say it's pretty clear, even if we came into it in mid-2017, which way the trend is. And this is an extreme example, and it's carried on pushing higher. And here we are now, just a little bit below the highs of that trend in early November. So don't discount a simple approach of just looking at what the price action is doing. Let's try and refine that, though. Let's talk about the idea of trend lines. Here's a great example in both directions. This is gold. So at the moment, I'm focusing on about mid-April 2018, these highs, and the slide that we saw into August. So let's just put a trend line on that slide. So in a downtrend, our trend line sits on top of the peaks. This trend line did a great job of keeping the price under pressure. It wasn't really a valid trend line, you could say, because really we need 2 touches to draw our trend line and a 3rd touch to confirm it. And we never really got that. But we did see during August, the market start to turn around, form a base and start to move higher. So maybe now we can pick up on a new trend. So let's just pick up on the start of this trend. So at the time here, we've got till the end of December or mid-December 2018. Let's pick up on the start of this new trend. So for my money, we have got 3 touches here. Let's just zoom it in a bit. So we've got the low in August. Arguably, this is 2 and 3 here, but if you want to be pedantic, let's touch number 3, mid-November. So that is the real confirmation that this is a trend line. So for now, that was one buying opportunity. I would suggest around about 12.05, 12.10, and from then on, any weakness back to that trend line is viewed as a buying opportunity. Let's walk forwards in time. So I've jumped forward. We're now 3rd week of April 2019. The market has been as high as almost 1350. We've sold off back to 1270, but for now, don't forget that trend line. We are expecting it to hold and the market to push higher. Let's jump forwards again. So it gets a little bit messy and the market does sort of flip around the trend line. It closes below it for one day, but then pushes higher into June, trades up to 1400. Once again, the trend line has done a good job. Let's just take it out now so we got the full history. And this is where we are today, trading at 1450 after the market's been as high as 1550. That trend is still up, so at the moment, even if we did plunge, $70 lower than where we are now, down to 1375, that trend is still valid. So I know that people, when it comes to trading, I think particularly when people are new to trading, they want to make it really complicated. You don't have to overcomplicate it. Here's an example of a simple approach on a major market like gold. If you apply it to the likes of any other market, S&P, the pound, silver, oil, you will see trends all over the shop. So again, don't discount an approach like this. But let's talk about something maybe a bit more mathematical. Like I said, I think there is a lot of weight that should be given to the simple trend line, but some people prefer to add maybe something complementary. So now let's take a look at the idea of moving averages, a more mechanical trend following technique. So let's bring in a moving average. Let's pick a 20-day moving average and put that on the chart. So put simply, all our 20-day moving average shows is the average price for the last 20 days. So if we have a look at where the moving average is now at the time of recording, it's about 1471. So the average closing price, I've got it set to closes here, for gold over the last 20 days has been $1,471. And again, at the end of today, it gets recalculated, and so we go on. So moving averages are used the traditional way of using it, simple way of using it. If the price crosses above the moving average, like down here, in late May 2019, that's a buy signal, and it holds it all the way, gets a bit choppy here in the summer, another buy signal there in August, and off we go. And then a sell signal here, September the 5th, when the price falls below the moving average, suggesting again that trend has flipped the other way. Again, it gets a little bit choppy because the price of gold goes sideways, but the last signal we had off this particular moving average was November the 5th, when the price fell below 1495, and it's been short since then. Of course, if I change this, if I make this a 50-day moving average, I'll have less signals. It'll be slightly further away from the price. Let's just change it now. So here's our 50. It's a longer term moving average, clearly than 20, because it's taking 50 days into account. Buy signal again down here, end of May. Doesn't get caught up in all the choppiness here in July. But again, it does get a little bit choppy and messy over the last few months. The last sell signal we had, again, was that November the 5th move on the break below 1495. So again, the 50-day moving average, slightly more patient. You are going to maybe get into moves a bit later, but arguably should keep you out of the way of a lot of the choppiness in markets. So that's one way of using moving averages and the price in conjunction, a simple price moving average crossover. Oscillators have been around for many decades, so I want to focus on one that can help us, particularly when it comes to trend reversals, and it's the one that's been around, I think, the longest. It's the RSI, so let's have a look at that on the charts. So we're sticking with the gold chart, and we've got here an RSI, 10-day RSI, so relative strength index. It's one of the most basic forms of oscillators, classic overbought, oversold. When the RSI is above 70%, like here, it's the suggestion the market has moved too far too fast to the upside and is due a correction. So it looks at the typical range of the last 10 days, applies a calculation. We have a result between 0 and 100%, anything above 70%, the market is said to be overbought. On the downside, if the market's been falling, if we go back to April of this year, let's just zoom that out. So you can see here, the middle of April, the RSI briefly dipped below 30%, and again back here in March. So the market is said to be oversold. So again, it can be a suggestion the trend you're following is running out of steam. So it's a way of identifying a possible turning point. However, it can be somewhat unreliable. So what many technical analysts use is the idea of divergence. Let me show you what that is. So we had a great example for the top in gold, which is always, of course, easy to spot in hindsight. But going back August, September, the price of gold moves to a high, then moves higher still. But you can see, look what the RSI is doing. It's falling away. So this is known as bearish divergence. So it can be a suggestion that perhaps, even though the market looks strong, perhaps the market's gone far enough for now in this example, and it's time to flip round the other way. Let me find an example of bullish divergence. So here's a bullish divergence example. This is mid-May through to the end of May for silver this year. So the price has been sliding and slid from $16.20 down to about $14.40. The price is making new lows for the down move. However, if we look at our 10-day RSI, it's making higher lows. So it can be a suggestion that perhaps the market is running out of steam to the downside and it's time for a turn. That is, of course, how it did turn out. And you can see it's not a signal that crops up very often. So I think if you do see divergence on the chart, if you're following a trend, it can be a good suggestion that perhaps you want to think at the very least about tightening up any take profit orders on your position and just be aware that maybe the trend is going to flip the other way. The final technique we're going to look at, it's always, I think, a bit of a controversial one. I must admit, I'm not a fan, but let's see how the wonderful world of Fibonacci can help us when it comes to identifying and trading with trends. So the final thing we're going to look at is the idea of Fibonacci retracements. I've got a confession to make. I think Fibonacci is utter rubbish, but let's take a look at it because some people do believe it. So it's this approach that the markets conform to certain rules. And if a market has gone up X, if it falls back, we should look for areas of potential support at these certain Fibonacci ratios on the way back. Let me just plot these on the chart. It'll make a lot more sense if we get them up there and we can talk about them. So again, we're on gold. If I start with the move from the beginning or the middle of May this year, this is how we'd apply Fibonacci retracements to this rise. So we're going off the lows all the way up to the recent highs. Let me just drag that across. So there we have our Fibonacci retracement. So the market's gone from about 1268 up to 1555, 1560. If the market drops back 23.6%, and it bounces, then that's fine. That's a confirmation the trend is okay. So that's our first Fibonacci retracement level. If it breaks through there, we'll be looking for a move for the market to drop to the 38.2% mark. So that's retracing 38% of that move. And again, actually, this has held so far. If you look at the November lows, they did hold right on that 38.2% retracement. I still don't believe it. Then if it breaks below there, we'll be looking at 50%. And I think really the big level is the 61.8% level. So some practitioners of Fibonacci will say, well, look, if the market's going up and it falls to 61.8% of its previous rise, that trend is still valid. But if it breaks 61.8%, the trend is over. Look out below. We're going back to where we started from. So based on the Fibonacci retracement analysis on the price of gold, that recovery for this year off those May lows is still very much intact. It's held above the 38.2% level. And we're okay down to 1380, which is 61.8%. So that's one way that people who are fans of Fibonacci, which is not me, will use this approach to try and confirm the trend they're following, even though we're retracing, is still intact. So for me, as you might have guessed, my favorite is the simple trend line. Let's have a discussion in the comments about which you prefer and why. But for this look at following trends, we'll leave it there. So from me, David Jones and Capital.com, good luck with your trading.